right. Good morning. It is 9:59 on Tuesday, April 4th. So it's time for our weekly webinar. Good to see everyone. Hopefully you can hear me okay. Looks like everything's running fine. That's good. Okay. So today we're going to follow our normal format. We're going to have a few minutes of our slot updates. Also have a couple questions that came in and some things some additional information from, first of all, a class I had, and second of all, an email that was sent to me this week regarding Roth contributions. So I want to just explain the format. So we're going to have that few minutes of the slot update and other IRA updates, I should call it. We're going to have some market updates, and then our financial planning discussion today is tax-free RMDs. And there are two ways you could potentially have tax-free RMDs. We're going to explore both of those. So an RMD, of course, is a required minimum distribution, and that's a crawl on some people's sides because they have to take money out of their IRAs even if they don't want to. And I'm going to show you how you could potentially receive that distribution tax-free. Okay, so let's get into it. Oh, I wanted to remind you that we do have a big upcoming event at the Newtown Theater in Newtown, and with Ed Slott, the master of IRA distributions, and David McKnight, the master storyteller for everything tax efficient. And that's coming on May 16th at 6:30. And again, at Newtown Theater. So you'll be receiving invitations to that. If for some reason you don't receive an invitation and you'd like to come, you can email us at questions@attleborowealth.com. That's questions@attleborowealth.com. And we'll see if we can accommodate you. There's only so much room at the theater, but we'll do our best. We're also going to have a great food from Joe Garvey. Joe does all of our catering, or most of our catering in the past, and we always get rave reviews. Okay, so a couple headlines, or one big headline this past week. Last week, the Social Security and Medicare's trustees report came out. And once a year, from the federal government, there are trustees, board of trustees for the trust fund for Social Security and Medicare. And every year they publish this extensive report, and it frankly looks worse every year. So this year, though, it was a little bit of good news and a little bit of bad news. So the good news I'll start with the good news, is that Medicare at last year's report was scheduled to be depleted. So the trust fund that supports Medicare was scheduled to be depleted by the year 2028. So that is right around the corner, 5 years from now, right? But and what does that mean? Of course, that means that only about 91% of the benefits, Medicare benefits, would be available to be paid. So something would have to be done between now and then. It's not likely that anybody's going to cut anybody's benefits. There may be some adjustments for later generations, but folks, if you're close to Medicare age, or collecting Medicare benefits now, or Social Security, please don't worry. Those benefits are going to be there for you. I trust in the lack of significant courage to make any changes at all, but certainly not for folks who are collecting benefits. Now, not that I don't think they should be cut for anybody receiving benefits, but there's simple changes that could be made to make Social Security and Medicare more sustainable. Anyway, so last year's Social Security and Medicare trustees report told us that the Medicare trust, the trust funds for Medicare, were to be depleted by 2028. This year, it looks like now it's 2031. Yes, 2031. So we've gained 3 years, mostly because of adjustments to medical costs. But hey, I'll take it, because ever since I've been tracking this for the past, 7 years, I guess now, we've lost time, I think, every year. But we did lose time with Social Security. So Social Security, we've lost another year. Not that we happen to just be a year closer, but the target date has also come closer. So not only are we a year closer to the date that they projected last year, in last year's report, which was 2034. Now they're projecting 2033. And if you recall, the Treasurer's report that came out in February said 2032. So somewhere between 2032 and 2033, depending on whose report you believe from the federal government, Social Security that trust fund will also go to zero, and then only about 71 to 77% of benefits can be paid from the trust fund. And I'm sorry, I have a correction here. It used to be 91% of the benefits from Medicare when that would be payable when the trust fund depletes, but now it's 89%. So my apologies there. And it looks like they've secured that it's 77% of our Social Security benefits will be able to be paid after 2033. So those funds go to zero, not enough money coming in to support the great American programs of Social Security and Medicare. And what do we do from there? And as you know, we believe, and we have a lot of evidence to support it, that significant tax increases are going to have to happen sometime before then to be able to pay for these programs as well as others. Okay. So let's talk about our in-house questions. So the first was, we just finished up a class at Holy Family University, and I had an individual come up during one of the first classes. So let me just remind you, if you haven't attended a class, a live class, or you haven't attended one in a while, they're structured as 3-hour classes, two different nights, so a total of 6 hours, with the exception of we did have a 5-hour Saturday class at both Holy Family and Villanova. We hadn't done that in some time, but it worked pretty well. The problem is it doesn't include the estate planning piece, which I sent out as a separate add-on. But so during one of our first, I can't remember if it was a Tuesday night or a Thursday night. We have a Tuesday evening series and a Thursday evening series. Again, 2 nights, a Tuesday and a Tuesday and a Thursday and a Thursday, both 3 hours apiece. So during one of the first classes, an attendee came up to me and he had questions about an inherited IRA. So unfortunately, his mother had passed away a few months prior. She was in her 80s, and he said, do you have to take, he said, I've been listening to you. So he had attended a previous class in New Jersey sometime before that. And he said, I've been listening to your webinars, and you use that description about inherited IRAs and the RMDs that you received from Sarah Brenner. I'll give Sarah her due here, but Sarah taught us during one of our education courses from the Slott Group that once these RMDs start, they have to keep going, right? These required minimum distributions from inherited IRAs. And she used the line from the Stones song, start me up, start me up, start me up, start me up, I'll never stop. Once these RMDs start, they have to continue. So that's a really good way to remember this complex rule. And the complex rule says that if the original owner of the IRA passes prior to the required beginning date, so right now it's age 73, so prior to age, not age 73, but if the person turns 73, say in 2022, but they had not reached the required beginning date, which is April 1st of the year following the year they turned 73, then no RMDs have to be taken for that inherited IRA, and it can all be withdrawn by the end of that 10th year. Of course, you can take distributions along the way, but there are no required minimum distributions if the original IRA owner had to start taking their RMDs. But if that original IRA owner had passed the required beginning date, again, April 1st of the year following the year that they triggered that RMD age, then these required minimum distributions for the person who inherits that RMD must continue. And there are some exceptions. There are eligible designated beneficiaries. And they include surviving spouses, minor children of the account owner, disabled individuals, chronically ill, folks, and beneficiaries not more than 10 years younger than the IRA owner. And this fellow fit none of those exceptions. So he came to me and he asked, okay, do I have to take distributions? And I said, well, your mother is in her 80s. She follows your old rules of 70 and a half. She's past her required beginning date. So yes, under the new rules, you have to continue to take distributions. And then completely distribute those funds by the end of the 10th year following the year that she passed. So he came back to the next class, excuse me, and said, I'm sorry, but you're wrong. I talked to the custodian of the account and they said, I don't have to take RMDs. And I said, well, I don't know what to tell you, but the custodian is wrong. And I don't remember who it is or it was. And I don't even know if I'd repeat it, but the custodian was wrong. The custodian told this person that he did not have to take RMDs, and he was saying, well, you're incorrect. And we went back and forth a little bit, and I basically said, look, I don't know what to tell you. I can show you the regulations. I know that they can't because the information is that they're giving you is wrong. And they said, well, it all changed in 2020. And that's true. It did all change in 2020 under the original Secure Act. But and there's been a lot of machinations from the change of that Secure Act to where we are today. But the regulations that came out last summer, IRS regulations, say exactly what I just told you. If you've passed the required beginning date, or the decedent had passed the required beginning date, then the person who inherits those funds, that IRA, with the exception of an eligible designated beneficiary, have to continue those required minimum distributions. So I hope that the risk here, of course, is that, you have somebody on the other side of the line, and these are, very, very nice and capable people, typically when it comes to investment, but typically they know nothing about financial planning and especially these intricacies about IRA distribution planning and issues and rules and laws and regulations. And these are complex, and you should be getting your advice from somebody who knows and understands them. And I can't tout the Slott Group enough. Again, poor Sarah received an email from me at about 7 o'clock this morning asking for clarification for an issue we're working through with a prospective client. And she responded very quickly with some details and references, and that's what we expect. And that's how we continue to thrive and grow as members of the Slott organization. So the risk, of course, for this individual would have been he listens to the person on the phone. He does not take required minimum distributions. The IRS at some point will realize that, and he'll be fined now 25% of what he should have taken out. And if he corrects it within 2 years, 10%. So likely it would have been 25% for a period of time, and then maybe 10%. I don't know, but penalties stink no matter what, especially when they're easily avoidable. Most of them are. But be careful who you're getting your information from. All right. The next one was an individual who just emailed me yesterday, and he had a question about Roth contributions. And he said, I did a conversion that added additional income. Now my modified adjusted gross income is over $300,000 or at $300,000. Therefore, I cannot do a Roth contribution because of these conversions. Well, and he went on to ask about backdoor Roth contributions being more complex. And he said, it seems a few people, including tax accountants, understand it. And that's true. Unfortunately, we understand it very, very well, again, because of the resources we have. But backdoor Roth contributions can be, they are complex, but they're used all the time. And there's no reason to avoid them if it works for you. The IRS does not have a problem with them at all. They continue to allow them in every change of the tax code. So, but let's address item number one first. This person said their modified adjusted gross income was below the level where he could make a Roth contribution prior to the Roth conversions. The Roth conversions, in his opinion, had taken him over the modified adjusted gross income level for Roth contributions. However, what he failed to realize is that, and I can't blame him, because I have this conversation even with accountants on a regular basis, several times a year. Roth conversions, while they count for taxable income, modified adjusted gross income for many things, don't count for the calculation for phase outs for contributions. So as long as you meet the other requirements, you have earned income, and it's at least to the amount that you're contributing, then and you're below the phase out levels anyway. Say if you're at $150,000 in modified adjusted gross income, to make it simple, and you convert $150,000, so now that would take you over those phase out levels. You may think, but it doesn't. Your modified adjusted gross income is still $150,000 for the purposes of the Roth contribution. So you can go ahead and make those contributions. The Roth conversion part of it doesn't count. And I just have to stress again, this is another reason not to try to do this on your own. Develop your team. Make sure you have a qualified certified financial planner. Make sure you have a qualified CPA, because not all CPAs get it. There are many out there that don't do this tax planning at all, frankly, but aren't in this space of tax efficient planning. Very, very few are, frankly. And you want that qualified attorney and a state attorney. And for most people, it also makes sense to have a elder law attorney. Okay, so now we're going to jump into, I'm going to share the Slott mailbag. And we just have one today because some of them the other ones were very, very specific. But let's jump into this so you can see that these questions were answered by Ian Berger. And in a couple of weeks, I'll be with Ed and his team again down in Maryland. So I'll have a bunch of new information to bring back to you. And if I haven't shared it with you, I'm sitting on Ed's advisory panel this year. So I'm excited about that. But the question here is, and you can follow along right after the question right here. In a recent blog post, you said that the deadline for contributing to a Roth IRA for 2022 is April 18th, 2023. Does that include converting a traditional IRA to a Roth? So I'm hoping you folks who've been listening for a while say, no, it doesn't. But this is a question we also get often. And this is something I could, if I could ask for just one simple thing out of Congress, if I could just change one simple thing about Roth conversions, it would be that we had until the tax filing deadline to do those conversions for prior years. But that's not the case. We have until 12/31 of 2022 in this case to get those Roth conversions done, not contributions, conversions, two different things. So let's read Ian's answer. I know I just answered it for you, but let's read what Ian says. Ian says you can make a prior year traditional IRA or Roth IRA contribution, but you cannot do a prior year Roth conversion. So you don't get the extra time to do a Roth conversion and consider it a 2022 conversion. For a Roth conversion to count as taxable income for 2022, the traditional IRA distribution would have had to occur by December 31st, 2022. If that traditional IRA distribution occurs anytime in 2023, the Roth conversion would be considered taxable income for 2023. Good explanation, Ian. So here's our next question. And this is something we don't talk about enough, honestly, are these HSAs. I have an HSA. You have to have a high deductible plan, but HSAs are wonderful from a tax efficient point of view. So the question here is, if you have a single HSA, a health savings account plan, can you use the funds for only your eligible medical expenses? Do you need a family plan to include your spouse and dependents' expenses? Also, great question, Jim. So let's see what Ian says to Jim here. Ian says, hi, Jim. You must be covered by a high deductible health plan, an HDHP, to be eligible for an HSA. If you are the only one covered by the HDHP, you're eligible for a self-only or individual HSA. If someone else is also covered by the HDHP, then you qualify for a family HSA. An HSA can be used for family members' medical expenses, even if they are not covered by a HDHP. Let's say you only have a self-only HSA because your spouse and dependents aren't on your health insurance plan. You can still withdraw funds from your HSA for qualified medical expenses that your spouse or dependents incur. Interesting. We don't talk about HSAs enough, so I appreciate Ian posting that today. Okay, So here we go. Moving on. We're going to talk about the markets. Oh, and if I didn't mention this in the beginning, let me share this now. We break this. We break this webinar up into two parts. So, and you'll see if you're viewing this on YouTube and you've been on the YouTube channel, you'll actually see two different videos with the same topic. The example today is tax-free RMDs. So you'll see weekly webinar, tax-free RMDs, and you'll see financial 15 tax-free RMDs. So the weekly webinar is the entire format. It's the 15 minutes or so of IRA updates from the Slott Group, 15 minutes or so of market updates, and then 15 minutes or so of a financial planning topic. So if you want to listen to the entire webinar, you can. Right now, they're both available on YouTube. Soon, the weekly webinar is going to be member or client only, probably within the next few months. So, but the financial 15 will likely be available on YouTube for anybody to search it. The financial 15 is just that last portion, the financial planning strategy. So if you just want to learn about tax-free RMDs, you can jump to either, you can look at the indexing in this video. What I mean by indexing is if you scroll along, the bottom of the screen, it'll point to what the topic is, or in the description, there are links that jump to the different sections. And I didn't say it this morning, but or as we started, but if you're watching this on YouTube and you haven't already, please subscribe, like, and hit the notification button so that you don't miss anything and so that you can comment. And I do recognize that someone said that they had a hard time commenting, even though they're subscribed. I'll try to figure out what that is. I'm not a YouTube expert, but I'll try to figure out what that is if you're listening, Kathy. Where was I? Yeah, so that's the format. So you may see two different videos with the same description. All right, let's talk about the markets. So my friends at Invesco let me down today. I didn't get their chart, but Empowerment, thankfully, sends out something similar. So I'll just share with you that it was a good week last week. The Dow Jones Industrial Average was up 3.22%, which took it over the negative level, right? So it had been down year to date so far before that. So the Dow Jones was up 3.22%. The S&P 500 was up 3.48%. The NASDAQ was up 3.37%, and that gives us a return for the NASDAQ of 16.77%. So remember, this is as of Friday, this past Friday, which was March 31st. Mid-sized companies, the S&P mid-cap up 4.5%, 4.49%. Still at 3.36 for the year. The small companies, Russell 2000 was up 3.89 or 2.34 for the year. So everything kind of across the board was up except for that Bloomberg U.S. Aggregate Bond Index. So that's where most people have their bonds is in that space that index covers. And that is up 2.96% for the year. But last week it was down 0.46%. So we had some good growth in the markets for sure. Let's look at what some of the analysts are saying. So let's stick with Empower first, since they gave us our chart that we needed today. And they write, I'm just going to read it to you. All major indices were up over 1% on the day Friday and finished the month strong, and also the quarter. So March obviously ended the quarter, first 3 months of the year. The tech-heavy NASDAQ posted its strongest quarter since March 2020. Now, this is an important point, but most of that index is being carried, much like it was in 2020, coming out of the recession, by Apple, Microsoft, Amazon, Tesla, and NVIDIA. They were all up over 20% for the quarter. And really carried the growth of that index. So again, Apple, Microsoft, Amazon, Tesla, and NVIDIA. So no recommendation to buy or sell these positions. I'm just mentioning it because it's mentioned in the research report. But they go on to say, if it weren't for these high-flying tech-oriented names' contribution, which also comprises significant weight in the S&P 500, then the returns would be far less compelling, they write. So you've got a big percentage of two two of how we indices or measuring points that we use to measure the market, driven by a small number of companies. So that's always a risk. There was a report that came out Friday regarding inflation. It's the core personal consumption expenditures index, or the PCE, the personal consumption expenditures index. And this is the preferred inflation measure by the Fed. That rose 0.3% or 4.6% annualized in February versus 0.6% for January. So that's below expectations. So the thought may be that inflation will start coming down a little more rapidly. So the and with that, there may be some easing on the Fed's direction about continuing to raise interest rates. So we'll see what happens. But the inflation still hasn't gone away, obviously, and the Fed's target rate is 2%. So there's still a lot of work to be done. But they were saying that could be a reason why we had such lift in the markets. Consumer confidence, which we also saw Tuesday. I'll just read this. Tuesday, we saw an update from the conference board on the consumer confidence, which unexpectedly rose and beat expectations with a read of 104 versus 101. So let me explain what that means. So the estimated was 101, came in at 104 for consumer confidence. So that's showing that consumers still have this economic confidence. They're spending money. They're doing these things that are really a little surprising, considering the fact that interest rates have gone up and everybody's talking about a recession. And at some point, we're going to acknowledge that we're dealing with a recession. Let's see. And they write a large contributor to the consumer's views on the economy and a large component to inflation is housing. Last week, we saw dual reads on home prices, which presented slightly mixed views. Home prices continued to decline, down roughly 3% from the record high in June of 2022. Let's see. While the Federal Housing Finance Agency home price index held relatively steady and even increased during that time. So we're really they go on to talk about different regions and whatnot, but we are still seeing a decline in housing for sure around here. I think people can probably see that that's happening as well. So then let's go to our friends at Cornerstone. They also talk about the consumption, the PCE, the personal consumption expenditures index. And they talked about it being the Fed's favorite inflation gauge. So that's two examples of that. And then they talked about the labor report that's coming in on Friday. There's a lot of other information in here, but they talked about this week. We had the ISM manufacturing yesterday. Tomorrow, Wednesday, we have ISM non-manufacturing. So non-manufacturing, which is the larger side of the economy. And the ISM report yesterday, the thought is that it's starting to see the effect of the banking crisis on manufacturing and borrowing and whatnot. But Friday's labor report, the markets really have keyed in on this report and will be looking to see if hiring is slowing, they write, which would bolster the case for the Fed pausing its hiking campaign. So Friday's going to be an important report. Okay, I think that's enough on the market. Still a lot of uncertainty around there. And how do we battle the uncertainty? Well, you have to have a substantial plan, right? A comprehensive plan. And with that comprehensive plan, you can work out your account segmentation, asset allocation, principal protection percentage, and account segmentation. So that is really how you manage these insecurities about your funding and the markets and where your funds are coming from in retirement. Now, if you're within 3 years of retirement, you should really start this account segmentation process. If you're outside of 3 years, 5 years, you can probably exist in those first two tiers: asset allocation, principal protection. But that third really third leg of that stool, account segmentation, is really important as you're entering a few years prior to. And it could be five years or more, but certainly 3 years before retirement or as you're entering retirement, and throughout the whole rest of your life, right? That you're going to have that account segmentation process in place. But that's something you just have to be considering. And if you don't know what I'm talking about, you can go to our website under services, investments, and look at the video about account segmentation. And that's called the 3 pillars of investing. Okay, let's jump into our financial planning topics. So let me set myself up here. All right, you should be seeing my screen. It looks like you are. So today's financial planning topic is tax-free RMDs. So there are 2 ways to get to, let me pause. I'm sorry. So if you're just joining us for the Financial 15, be sure to like, subscribe, and hit that reminder button. But if you want to see, this is the tail end. This is the last 15 minutes of our full weekly webinar. So there's another half hour of this where we talk about tax law updates and IRA distribution issues and things like that. And we talk about the markets and read some analyst reports and review, what happened last week, what we think is going to happen in the coming weeks, months, et cetera. But if you want to join that weekly webinar, you can certainly do that, or look at the video for that, or just continue to follow these Financial 15s. And the Financial 15s is just that last 15 minutes where we explore a financial planning topic. And today's financial planning topic is tax-free RMDs. So again, RMDs are required minimum distributions. So a required minimum distributions is it's exactly what the IRS tells us we must take out of the IRAs after we reach a certain age. So right now that certain age is 73 years old. It soon becomes 70. Well, it eventually becomes 75 years old, and who knows if it's going to increase more than that. But this is the number today. So it was 70 and a half for the longest time, and then that changed to 72 back in 2020. And now, as of 2023, your RMD age is age 73. And you must start your required minimum distributions on your required beginning date. And the required beginning date is April 1st of the year following the year that you turn 73 currently. Well, the first way that we can have a tax-free RMD is a common way. People are starting to really use this and hear about it. So we're going to talk about the more common, but stick with me because the second one is really uncommon, and it really, people get confused about this when it trips people up. We talk about this in our Changing World of Retirement class, and I often see confusion in people's face. So it takes a little bit of understanding, but people, many of you folks listening to this webinar, or if you're watching it or listening to it, attending classes, reading books, more and more people are starting to get of this tax efficient mindset and approach. Not a lot, not enough, right? So there's still the vast majority of people are still stuck in that tax deferred paradigm and are going to be forever. But many of you are starting to shift to this approach of, hey, if I start working towards being tax efficient, all these tax rate increases that are eventually going to happen in the future, to some degree, if not significantly, I can avoid, right? I can get myself off that set of railroad tracks, not get hit by that tax train, and I can work towards that. So the qualified charitable distributions are getting much more popular. But that second way of getting your funds out of your IRA tax-free is not talked about enough. And so stick with us because that's a little more complex. And if you're just listening, this might be when you can listen to this first, but you're going to want to come onto YouTube and see the video to be able to watch what I'm doing here, because it's going to be important to see that. All right, so first let's talk about qualified charitable distributions. So number one, you must be 70 and a half. So I know that the RMD ages have changed. It's now 73, will be 75. But the Congress and IRS have never adjusted this age. The QCDs were started with RMD age is 70 and a half, and it never stopped, right? It's always 70 and a half. But it's not the year in which you turn 70 and a half. It is you have to have crossed that 70 and a half birthday. I did air quotes, birthday. So if you turn 70 and a half this year, right? On your birthday's in January, you can't do a QCD until you actually hit past that half year mark. Really important. And people make that mistake because it's valuable. You can distribute up to $100,000 per year per individual from your IRA and not pay tax. How in the world would you do that? Well, you distribute those funds direct to a qualified charity. Do not stop at go. It has to go right to a qualified charity. Do not put the money in your checking account and then write it to the charity. If you've been writing checks all year long and at the end of the year say, hey, I want to have this as a QCD, it's not going to work. It has to go right to the qualified charity. And the IRS determines what the qualified charity is, so make sure that it's qualified. If this isn't the end all be all, but 501c3 is a good way to start there. But you want to make sure it's qualified charity per the IRS. It of course can satisfy an RMD. So if your RMD is if it's up to 100,000 and under Secure 2.0, I should mention. Secure 2.0 starts to adjust this for inflation. So that Secure 2.0 is that's actually not what it was called, but that's what we're calling the act that was passed about 9-10 weeks ago now. And starting this year, I think it's 2024. It's going to, the $100,000 will start to be adjusted for inflation. But right now we're working with $100,000. Well, that can satisfy your required minimum distribution. So if your required minimum distribution, for example, is $98,000 or $100,000 or less, right? Less than your entire required minimum distribution for an individual can be satisfied by a qualified charitable distribution. So you can't, if your $100,000 is 50% for you and 50% for your spouse, and you do a $100,000 withdrawal from your IRA, send it direct to a charity, that's not going to work, right? Your spouse is still going to have to do their RMD, their individual, right? But if you did 50 and 50, you could do that to satisfy that RMD. So be careful. Of course, know the rules or find somebody who knows the rules to help you with that. And I noted here, so I didn't forget, a financial planning strategy. So this can be a really strong strategy in your financial plan. You don't want to over-converting. That is also a problem. Not enough people know about Roth conversions, but sometimes once they get into it, they kind of hit the gas too heavy and they start saying, I'm going to push everything over to my future tax-free Roth IRA. And that's not always the best case. I'm going to talk about that a little bit in section 2 here, RMDs below standard deduction. But with charitable contributions, yes, with charitable contributions, you also want to take a look at that, because if any of your retirement plans or IRAs are going to be left to a charity, you want to consider not converting that, because you won't pay tax on those during your lifetime, and the charities won't pay tax. So it would be a real shame to move those funds over to Roth. You pay tax at that point, right, when you shift it to Roth. And then if you left it to a charity, they don't pay tax on even if it was in a traditional IRA. So there would have been a useless amount of tax paid. And we don't want to overpay our taxes. So be aware of over converting. Yes, we want to convert the right amount every year that makes sense for you, but we don't want to overdo it. So with financial planning strategies, be aware if you're charitably inclined, if you're going to send money to charity, pay attention to how much you're converting. And just because I'm talking about financial planning, you should review this every year. Okay, now here's the big one. So QCDs, not very complex, just enough to get you in trouble if you don't understand the rules and you try to be cute with it. But this is a really good example saying, well, hey, it says that we can give $100,000 a year. When I say this, I'm pointing to these two $50,000 RMDs. When somebody will do this, I'm sure someone has done it. Hey, my wife and I, we've both got to take $50,000. I'm going to distribute $100,000 out of my IRA and send it right to a charity. Therefore, that's a qualified charitable distribution. We've satisfied the QC or the RMD. And the problem is that might go on for a few years. And then it's discovered that, okay, spouse did not take their required minimum distribution, even though you thought that it went to that money went right to the charity. That's fine. You don't have to pay tax on it. But spouse did not take that RMD, and now you have to pay penalties, 25% or 10%, depending on when you rectify it. Even, listen, folks, if you did it for 3 years and that's $150,000, even if you got it all at 10%, who wants to pay that, right? $15,000 penalty. That would be terrible. So don't try not to get too cute with these things. So RMD, the next section here is RMDs, required minimum distribution, below your standard deduction. So there are a couple key points with this. Number one, absent any other income. I'm right here. So if you have pensions, if you have rental income, if you have too much in your taxable bucket that is generating dividends, interest, capital gains, K1, whatever those taxes, those gains are, those the things that we get 1099s and K1s for every year, that tells us just how much we have to pay tax on. If you have too much in that bucket, this strategy will likely not work. Be really careful with this suddenly single issue. And of course, monitor every year. So I'm going to talk about that suddenly single issue, but let me just kind of map this out for you. So follow me over here to the right. So first, we're going to look at just a reminder on your buckets. So in your taxable buckets, you can have just about anything in here. Your stocks, bonds, CDs, bank accounts, money market, what else? ETFs, you name it, just about anything. And we know it's the taxable bucket, remember, because you get 1099s every year and other, you can also get K1s, but you get 1099s every year, and or whatever the tax reporting is for you. And that tells us how much we've earned in short-term gains, long-term gains, dividends, I'm talking about capital gains here. Short-term capital gains, long-term capital gains, dividends, interest, etc. So that all equals tax. So that equals tax. And your custodian sends these forms out not only to you, but they also send them to the IRS. So the IRS knows exactly how much you've earned and exactly how much you owe on tax. So you've heard this over and over again, but there's a mathematically ideal amount to have in each one of these buckets to ensure that you have the most efficient streams of income during your retirement. And we know in this taxable bucket, it is 6 months to 1 year for me of expenses. Now, Dave, my colleague and friend, David McKnight, will say 6 months. That's fine. I also agree with 1 year of expenses. Like you have to have what you're comfortable with to some level. But if you have too much in this bucket, you're generating too much of the short-term gains, long-term gains, dividends, interest, etc., and it's too much tax. And it puts your Social Security to be at risk, your taxation, your Social Security to be at risk. This strategy I'm going to share with you right now, and then and many other things. So then in this tax deferred bucket, I'm over here. Remember, that is your IRAs, traditional IRAs, 401ks, 403bs, simple, SEP, 457, anything that you've promised that you're going to pay tax on later. So you get a tax deduction going in, or you don't pay tax going in because of payroll deduction, but you have to pay tax as the money comes out. And there is a mathematically ideal amount to have in this bucket. So you might say, that, hey, I want to get everything out of the tax deferred bucket, but that may not be the right thing for you. You might be able to keep something in there, and this is where people miss often. Now, again, if you have rental income or significant pension income, this strategy might not work for you. And these numbers I'm going to show you right now are examples. This doesn't mean that this is the amount that you should have in your taxable tax deferred bucket, or especially your tax deferred bucket. This is an example. Everybody's number is different, and you should have a discussion with a qualified financial planner to figure out what your number is. But let's just say, let me explain how this works. Let's say in all these combined, IRA, 401ks, 403bs, whatever is in tax deferred, let's just carry this down here, right? So this is still tax deferred. Let's say you have $1 million in here. Now, let's say you turn 73 this year. So follow me down here. You're 73 this year. And your first years, I'm going to share with you my table. So follow me back up here. This is the Uniform Lifetime Table. If you want to find this, you can go to attleborowealth.com. Attleboro. I can't write the whole thing on one line. I'm going to follow it. attleborowealth.com. Go to the slot corner. Page down, and you'll be able to download this table. But this is the table that tells us exactly how much we have to take out of the IRAs. So we count the amount in the IRAs or retirement plans. Retirement plans, remember, have to be calculated separately. IRAs can be calculated together. Another key issue, key item, critical issue that could make big differences to your retirement plan. But at age 73, we use the prior year-end calculation, and we divide that by 26.5 in this case. Let's make sure I got the right number. 26.5. And for the first time last year, this is a new table in 2022, they also use a percentage, 37.77%. So now we know exactly how much the IRS is requiring us to take out. So let's come back down with me down here. Now we're going to look at this $1 million. So we have $1 million and we're 73. So we know that we've got to take that $1 million, right? $1 million. And we multiply it by 3.77%. So that, of course, gives us $37,700. Now, you might think, well, geez, I'm going to have to pay tax on that. Now this is the amount that I'm going to have to pay tax on, $37,700. Well, that's right. However, we know that everybody at least gets a standard deduction. So I'm talking about tax deductions. If you're deducting your interest on your mortgage, or you've got a bunch of business deductions or whatever, and that all equals up to more than $30,700 if you're over 65 today, then you itemize your deductions. But if your itemized deductions are less than $30,700, if you're married, filing jointly, and over 65 today, then you at least get the standard deduction. So I'll show you where you can find that. You can download this form also. Let's come up here to this orange tax form. This is on the website as well. This is a 2023. I'm sorry, this one's not up here yet. Still 2022's up there until the tax filing deadline, or until the new website's done, honestly. So here are our standard deductions. If you're married, filing jointly, it's $27,700. But if you're over 65, you get another $1,500 a piece, right? So you get another plus $3,000 here. If you're over 65 and blind, if you're 65 and blind, you get a little bit more. Why they chose blind, I don't know, but that's what the rules say. And look at this. If you're single, and I'm going to talk about this, that's why I say look out for that suddenly single issue. It is $13,850. And if you file as head of household, it's $20,800. These are the most common. So we're going to focus on those. All right. So you want to look at that standard deduction. Everybody at least gets that standard deduction. So come on back down here. I think that's my last journey back up there. So if we know that you have to take $37,700, but you get a $30,700 $700 standard deduction, and you're not using that standard deduction to offset anything else, no other income, no big dividends, interest, short-term gains, long-term gains, no pension, no investment income, rental income. That's what I'm thinking of. Then you can apply this all to your RMD. So that leaves you $7,700 that you have to pay tax on. So that's not bad, right? But it can be eliminated, because first of all, if you're 63 and you've got $1 million, you've got a bigger problem, because that's going to grow. And if that grows at 7% a year, by the time you're 73, that'll be just about $2 million. So we're going to call it $2 million. It'll be 10.2 years, right? So let's say it takes a little while for you to get there. It's that extra 2 months, or not even 2 months, but just about $2 million. So then that of course would be 37,700 times 2. So that's significantly more. I didn't do the math. I apologize for that, but it's, what would that be? 74, 75. It feels like 75,150 maybe, but somebody can do that math for me. So that, of course, is a lot more than this, and your account value does grow. So if you're 73, you've got to, and you're at $1 million, for example, then you've got to worry about that million you have. If you're 63 and you've got $1 million, you got to worry about what it's going to grow to also. And frankly, if you're 73, you got to worry about what that million is going to grow to, because we want our money to continue to grow, and we have to take more and more. This is the smallest amount you're ever going to pay for your required minimum distribution. The percentage goes up every single year, so you have to take more and more. And it's not likely that the standard deduction is going to chase that. So how do you determine how much you should be able to keep in here and still have it be tax-free? Because this is not tax-free, right? Now you've got to pay tax on the $7,700. Well, let's just use this as an example. What if this is not your number, but what if it was $500,000? So at $500,000, then it would be times 3.77%. That is $18,850. You still get $30,700 if you're married, filing joint, and over 65. That's your standard deduction. So you don't pay tax on this distribution, because you would actually be left with about $11,850 left in your standard deduction. So that's good. So that means that this $18,000 comes out tax-free, or 0% tax, however you want to put it. $0 tax. A lot of zeros here. So zero is good, right, from a tax point of view. So this is just one simple example. Again, $500,000 is not your number. It's different for everybody. But this is a way for your required minimum distribution to come out tax-free. What's beautiful about this is that you've never paid tax on this money. Remember, you either got a tax deduction going in, or it was part of your payroll deduction, right? And you didn't pay tax on that money if it was a 401k plan or a retirement plan. So you never pay tax going in. You don't pay tax coming out. So you've got to be aware of these allowances in the tax code. Many people, this is another area where people over convert. I famously tell the story of one of my first clients that came in from our first set of classes, who told us, hey, I get it with the Roth conversions. I was talking to my insurance agent, and he said I should convert everything to my Roth IRA, and he had over $3 million in his IRA. So many of you may have heard this already, but I'm going to repeat it. He had $3 million in his IRA, and he said, my insurance agent told me I should convert it all in 1 year. Well, that's a lot, and it's usually not the right way to do it. For most people, is a big conversion like that. Very, very rarely. So we helped them develop a schedule to convert those funds, and they were able to keep about $350,000 in their IRA that they'll never pay tax on. So wouldn't it have been a real shame if they had converted that $350,000? First of all, if they did the whole thing at once, that would have been a shame. But if they would have paid tax on that $350,000 that they're never going to have to pay tax on, that would have been a shame. And by managing to keep it below your standard deduction amount, if absent any other income, well, you might be able to do that. But I talked to you about the suddenly single risk. because come over here. I'm going to track these side by side. Remember, these standard deduction amounts are married, filing jointly, and if you're over 65. Well, what if you're single? What if you have the $1 million? You know, your spouse just passed away. You each had $500,000. You inherited, right? You're the beneficiary of that IRA. Now that whole $1 million is yours. You're now 73 years old. Well, your RMD, folks, is still 37.77%. The IRS doesn't change that. So your RMD is still $37,700, but your standard deduction went from $30,700, I'm over here, to now $15,700 because you're now filing as a single filer. Right? You get 1 year as a widower, that filing status, but going forward, you're now filing as a single filer. Well, that is $22,000. That is taxable. And that's likely to be your smallest tax bill. So you've got to be careful. I always plan, when I'm planning for a married couple, I'm planning with the knowledge that one of them is going to pass away before the other. So I tend to play this much more conservatively. I will honestly tell you, I don't think I have anybody at the $500,000 level. I've got plenty of people at $250,000, approximately, probably as high as I said, $350,000. But people die during retirement. They do. One of you is going to pass before the other. So you've got to be really, really careful about your planning. And this, believe it or not, it just might be something that you're not thinking about. And maybe no one's even talked to you about before, other than, the long-term care and life insurance and things like that. The death comes into play dramatically in your tax situation. So that is the second way to have a tax-free RMD. The first is qualified charitable distribution. The second is, if you can do it, a required minimum distribution that is below your standard deduction. Remember, everybody at least gets a standard deduction. Today, if you're over 65 and you're married, that is $30,700. If you're single and over 65, it's $15,700, and they do adjust every year for inflation. We had a big jump this past year, but it's really hard to keep up with, and these have to be reviewed. How often? Every single year. Okay, that is the program for today. I hope that was helpful. Let's find I always lose my mouse at the end of the, okay. So I hope that was helpful. I hope that made sense. I hope you learned something today. If you have questions, you can send them in to me to questions@attleborowealth.com. If you have ideas like you'd like me to talk about, the question that I received about the contributions for the Roth IRAs and the conversion amount and how it affects the modified adjusted gross income, and if it affects the contribution amount. Did I say conversion amount? I think I meant to say contribution amount. That came from somebody who listens to this often and says, why don't you talk about that on your webinar? So I'm always happy to hear what you'd like to see, what you'd like to talk about. So they were two ways to distribute funds from your IRA tax-free RMDs. First, qualified charitable distribution. Second, an amount, a required minimum distribution amount that is below your standard deduction. All right, folks. Have a great week, and I'll talk to you soon. Take care.